Hello everybody, it's Tortoise Investing. Today we're going to be taking a look at 3 dividend stocks that you can buy and hold forever. Now we're going to be doing a deep dive into these through a little thing called Qualtrim Insights. So if you love dividends, investing in general, hit that subscribe button, join me on this financial journey, and drop a like. Helps a ton. Super free and easy to do, and I greatly appreciate it. Now, before we dive into those, I'm going to very quickly showcase my personal portfolio and how everything is looking. Things are looking very well so far. We will go to the holdings tab here. So top 3 positions, what used to be my main bottom one, now my main top one, extra space storage. At one point, less than 2 months ago, this was down 26%. I held strong. Dollar cost average through while it was down, and now it is up 16%. What a comeback. The Feds have pretty much said that they are going to pause for right now if the interest rates, and it's causing REITs to skyrocket. And once they start actually cutting them, I see this paying off for me very, very well and being a great long-term hold. But we got that. We got Canadian National Railroad there in second place. And the bottom 2 positions, SCHD, up 3.4%. And Hershey has been lagging, but I am still holding, down 12%. But that's A-okay. I am a long-term believer in that. May actually buy some more. I'm not 100% sure yet. Either or, let's go ahead and take a look at things. If you look here on Qualtrim Insights, the 200-day moving average for Hershey is down 18.97%. Kroger's is over 5%, and Walmart is down 1.63% off of its 200-day moving average. But over the last month, Walmart down almost 10%, so it might be a great opportunity on a pullback. Always do your own research before investing in anything. I'm not telling you what to buy or sell, just things that might be on a good deal. Again, look into them for yourself, see if they fit what you are looking for in investing. First up, we got Hershey Company, adjusted free cash flow yield of 4.18%, above 4% with that yield. I love that. At one point, this was over $270, now down to $186. The whole weight loss drug scare that has came up has made a lot of your food stocks have went down, a lot of especially your sweets and snack industry. But Hershey, I am a long-term believer that this is just going to be temporary. I'm going to be adding on this dip, and I see 5 years from now I'm going to be very, very happy with this purchase. My personal opinion yet again. Take a look here. Dividend yield 2.53%, payout ratio 46.29%. Take a look at the revenue. Revenue's been growing at a rate of 6.75% over the last 5 years. Very nice. Free cash flow 8.27% over the last 10 years, 12.76% over the last 5 years. Very, very nice. EPS 10.61% growth over the last 10 years. Very good, just up and to the right. Love to see it. Take a look at debt. Debt's at $3 billion. Their EBITDA was at 2.06 as of last year. My rule of thumb is I don't like companies that have more than 3 times their EBITDA in debt. That shows that might be something up with their financials, and they need to get that debt under control. I don't like when companies have a whole lot of leverage. Hershey does a really good job at not having a ton of leverage. They're at $3.7 billion right now is their latest update on their debt. So a little bit more, but still not even 2 times. We take a look at the dividend. Dividend's been increased at a rate of 9%, 9.4% over the last 10 years. And here lately, they've been doing increased hikes. So bigger and bigger hikes, over 15% over the last 2 years. Very, very nice. That is some strong compounding. Love it. Share buybacks, they don't really do too many of those. A little bit less than 1% over the last 10 years. The return on capital employed, those where this company shines. 2020, they had a dip down to 19%, but still, that's really good. 2021 at 20.3, and 2022 right at 22%. So some great ROCE. Usually company averages are around 9-10%. So this being pretty much double that and growing, love it. Absolutely love it. I love Hershey. Next up, we got Walmart. This one, a bit pricey still, but it's on a pullback. And when it comes to Walmart and the moat as big as this, you might not get that many pullbacks with it. Now, just free cash flow yield 2.92%. That's not terrible. Dividend yields 1.48%. A payout ratio 37.77%. So at one point here recently, this was, what is it, right at 170, down to 152. So again, it is in a little bit of a dip currently. Revenue's been increased at a rate of 4.09% over the last 5 years. If you look here, it's kind of flattened off, but it is accelerating yet again. The free cash flow, pretty much flat over the last 10 years, actually down 0.36%. Hopefully, this is something that they can get under control a little bit better. I know that they are wanting to be giving out bigger and bigger dividend increases going forward, and I think they're wanting to get their money management under control. But the thing with Walmart, it's a very defensive stock and not recession proof. I don't think anything's recession proof, but when it comes to recession resistant, I think Walmart definitely falls under that category. EPS over the last 5 years, 5.42%. 2018, 2019 was some dip years, and as you've seen, they were going on a downtrend here and now back up, and again, a little bit all over the place. This is more of a defensive play, not my personal cup of tea, but just wanting to let you know that it is currently what I would consider in a dip. The dividend, a slow but steady increase, less than 2% over the last 10 years, so not too much there. I think it's just been a penny a quarter. But again, this is something that they're wanting to start increasing more and more going forward. Now, share buybacks, that is something that they do. Over 2% over the last 10 years, so they have been chopping at that, so that is something that you like to see. I personally would rather have my companies be buying back shares than giving me big dividend increases. Why I own Apple. Apple doesn't give big dividend increases, but woo, they buy back those shares like crazy. And return on capital employed above that 9-10% average with Walmart. We got right at 13% in 2022. 2021's 14.11. 2022 was 16.47, and 2023 looking at 13.53%. I said 2022, and I meant to say 2020 was at 12.96%. Lastly, we got Kroger. Kroger, just a free cash flow yield, 6.22%. Now, this one was at a high at one point back in 2022, over $60, down to $43.59 now. We got a dividend yield 2.59%, payout ratio of 42.8%, not too bad. Revenue's been increased at a rate of 4.36% over the last 10 years. Free cash flow has been increasing at a rate of 4.8% over the last 10 years, but 15.53% over the last 5 years. They had some big spikes in 2021 and 2022. EPS 7.22% over the last 10 years, not too bad. Debt, they have 11.91 billion. The EBITDA is 7.74 billion. Again, no issue there. That still falls in line with my 2 times rule. Don't think we looked at Walmart's. Walmart's is 32.6, EBITDA is 30 billion. So again, no issue there whatsoever with Walmart. Walmart's got their financials under control. Dividend's been increasing for Kroger at a rate of 13.4% over the last 10 years. This company does some pretty reliable double-digit increases with their dividend. Love to see that. And they were buying back shares at a rate of 2.83% over the last 10 years. But they did issue out some more shares because they are trying to finalize this merger with Albertson. So hopefully that can go through for them. That was I think it's an all-stock transaction they were trying to do with that one. We will see how that unfolds. Return on capital employed, 2020 dipped down to 7.26, 2021's 8.36, 2022 10.61, and 2023 12.55%. So slowly but steadily growing a couple percentage points, and you do like to see a growing return on capital employed. So there are 3 stocks that you can buy and hold forever. You cannot Cannot hate on the power of compounding and the snowball effect. Thanks for watching. Make sure to hit that like button and subscribe if you're new. And until next time, take care. See yous.